As a business owner, have you ever looked at your bank account, looked at your tax bill, and thought, how is it even possible that I've worked this hard and still so much of it disappeared?
And then you hear people online throwing around phrases like, oh, it's just a write off. Like there's some secret playbook that big business owners are hiding from everybody else.
Man, I hear that all the time. And that's what makes this conversation so important. Because for a lot of business owners, the frustration is not just paying taxes. It's feeling like you don't even know what counts, what you're missing, or whether you're actually doing something wrong.
And that's the worst part, right? You're trying to build something, you're trying to do it the right way. And at the same time, you're still wondering, am I leaving money on the table or am I making a mistake that'll come back later to bite me in the butt?
So, in today's episode, we're breaking down the top tax write offs business owners should understand in 2026. Not the flashy internet nonsense, not the fake guru version, the real stuff.
We're talking about the deductions that actually matter, the ones people overlook all the time, and the areas where, well, things can get a little bit messy fast if you're not careful.
Because the truth is, most business owners are not missing some magical loophole. They're usually missing the basics, the expenses they could have tracked better, the deductions they could have understood a bit more clearly, and the habits that could have saved them real money over time.
So whether you're brand new to business or you've been doing it for years, or maybe you're just tired of hearing the word, just write it off from people who really never explain what it means or never had a business at all.
This episode is for you. This is the Fi Guys. Let's get into it. A lot of business owners think that tax write offs are all about finding clever loopholes. But in reality, the biggest wins usually come from understanding the basics, tracking your expenses properly, and knowing what actually qualifies as ordinary and necessary business expenses. Today, we're talking about this because most business owners are not missing some secret tax loopholes. What they're missing, again, is just the basics, the deductions they could have taken, the records they should have kept, and the lines they shouldn't have crossed. Today, we're focusing on the top tax write offs business owners should understand in 2026. And I want to emphasize that good tax planning is less about gimmicks and more about clarity, documentation, and consistency. Not every expense is deductible just because you own a business. Our goal today is to help business owners think more clearly about what may count, what often gets overlooked, and where people get themselves into trouble. The biggest thing that we need to understand is that business expenses must be ordinary and necessary for for taking care of your trade or your business. So, Dom, I know we've talked about this before. What do you remember about taxes being ordinary or tax write offs being about ordinary and necessary that you think people end up getting themselves into trouble about?
Yeah, there's so many interesting things about taxes, and that's pinch me, right? Pinch me. Did I just say there's so many interesting things about taxes? Crazy. This is like some parallel universe, right? But I've realized that from our last podcast, people will go to unbelievable lengths to try and save money on taxes. And a lot of it is, it's a little bit fishy. It's a little bit sketchy. And I'm excited because today we can kind of talk a little bit about the crazy things that people do. And a lot of them happen to be mistakes, right? But also the right way to set yourself up financially in form of taxes and whatnot. 'Cause let's be honest, nobody wants to pay taxes. Everybody has to pay taxes for some reason. I don't know. Should we revolt? I don't know. Boston Tea Party? I don't know who said that. Anyway, but yeah, I'm excited to learn a little bit how we can really avoid sending more money to Uncle Sam. He's not a very fun uncle.
Yeah, and the reason I wanted to bring this up is that for those of you when this time of recording comes out, like business taxes were just had to be filed not too long ago, and no, now normal taxes are coming due. So I noticed for myself that I was actually speaking with my CPA, and I was bringing up some things to them, like, "Hey, I have these things. Can we deduct this?" And they were like, "Oh, I don't really know if we can." So then I had to email them with like, "Well, this is the law. And this is how we're able to do this. What if we structured it this way? And they're like, oh, well, you're completely right. Yeah, you can totally do that. So my fear is that most people don't understand how tax write-offs work. They're not financial advisors. They haven't worked in finance for the past decade. So if their CPA or whoever their tax person is, Uncle Bob says you can't do that or you can do that, they're just going to be like, okay, cool, I'm going to do it. And you could end up getting yourself into a lot of trouble, or you could end up overlooking a lot of great opportunities that you just didn't know was there. So we say it on the podcast all the time, but you need to be your own hero. And that doesn't mean that you have to understand the ins and outs and the intricacies of every single tax law, because no one does and no one ever will because of how long the IRS paperwork is. But you do need to be your own advocate. And if you understand the way broadly, you can begin to see it and be able to advocate for yourself with your CPA. Because I know for me and for many other people that have learned these things, you can go ahead and bring this to your CPAs, you can bring this to your accountants, and they can say, hey, yeah, we can do these things. Because if you don't, there aren't very many proactive tax people that are going to be like, hey, do you have this, or this that we can go with? You need to be your own advocate. So today, that's what I really want to talk about.
I love this episode because one of the first things that I learned when I started my business was like, hey, you're going to have to put on multiple hats. Like you said, Chris, you're not going to be an expert in every area, but you at least need to know the basics of how they work so you don't get, excuse my language, but screwed over. Right. So that's what this episode's all about. So let's get right into it, Chris.
Yeah. So let's go ahead and start off with section one, what a tax write off actually is. Because when I think most people hear tax write off, I'm not sure if you've ever seen the show Schmidt's Creek. I've only
yeah.
seen a few scenes of it, but
Yeah.
there is a scene where one of the characters is saying like, "Oh, just send it to the write-off people. Like it's just a business expense. I just write off," as he buys a car and a couch and all this stuff.
Yeah.
And I think so many people they hear that word, "Oh, I just write it off. Therefore, it is free." But that's not really the way it works. A tax deduction simply reduces your taxable business income. And that means that that lower taxable income may reduce, and that's a key word, may reduce the amount you owe in taxes. But what we need to understand is that a deduction is not in any way, shape, or form free money. It simply reduces the portion of income that is subject to taxes. And this is something that I've seen time and time again that I really want to make sure that people understand. Personal spending does not become deductible just because you passed it through your business account. Just because I have a business credit card and say I want to go to Wendy's or I want to take the kids out somewhere. Oh, don't worry, I'll use my business credit card. Therefore, is now a business expense. Remember the key words. It must be ordinary and necessary for your business. And this is where people begin to really get themselves into trouble.
Do you find that a lot of people that have businesses, they cross that line? Is that like one of the most common ones they kind of cross? It's like, hey, I bought this expensive car, but it's for marketing, right? It's for marketing. And it's like, but is it ordinary to the business? Do you find that that's the most common one, or what are you seeing out there, Chris?
I find the most common one is people don't really understand what a tax write off is. So they just say, I will just write off anything. But not really understand what that means. And then when it gets time to come to the point where either you're talking to your accountant, if hopefully you have an accountant and they set you straight, or you're filing your taxes using TurboTax or something like that, and you have this box of receipts, and in there has just random stuff, and you're just saying like, yeah, all these things work, all these things. Like I wanted to buy this lawnmower for my house, so I bought it on a business credit card, and here we are. How often do people go on TikTok, go on Instagram, go on whatever, they hear a reel of someone saying, this is how much money I saved on taxes by just writing things off. And then people automatically say, oh, I should do that too. But for majority of the population, they don't even own a business. So that's not going to account for them. And then for other people, if you're owning something or selling stuff on Facebook Marketplace or whatever your business is, that doesn't mean you can do anything. It's not just some magical get out of jail free card. The most important thing is a write off is not about what you bought. It's about whether you can prove it's truly for your business. And this is something that's very important when it comes to the IRS. Unlike normal law, when you are innocent until proven guilty, With the IRS, when you audit, you are guilty until proven innocent. You have to prove that you did the right thing. And that is what kind of changes the script. So that's why you have to be very cautious. And sometimes you would have a consultant or understanding as to what things can and can't be written off. And that's what I wanted to get into in this podcast.
Let's continue on. I'm already learning more than last time, so let's keep it going. And I hope if you guys are learning something too, make sure to drop down below in the comments what nugget that's like, hey, I didn't actually know that. It's okay to be, you know, ignorant as long as we're learning, right? As long as we're improving. It's okay to be the dumbest person in the room. If you're the dumbest person in the room, you're in the right room. And now we're back to normal talking volume, right? But yeah, let's keep it going, Chris. This has been interesting so far. And
Of course.
that's
And
the
please
toughest thing
remember,
with taxes. Yeah.
it's all good. And please remember, I am not a CPA. I am not a tax professional, but I'm here just to give you the honest truth as to what things you can talk to your CPA, you can talk to your tax professional about so that they can make the right decision for you, or that you can have a better understanding so that you're not going through life just believing that, oh, I'll just write it off. It's just, it'll just disappear if I say write off loud enough. The first thing that we can write off is startup and organizational costs. Dominic, you and I have both started businesses. There are startup costs to organizations that can be deductible. Some of those things might be market research. It might be your legal setup fees. Have you ever set up an LLC in certain states? They do cost money. Some states are cool. Some states aren't, like California. Your initial travel for launching a business. Maybe you need to go around, you need to look around and figure out like, hey, where can I put this storefront? Where can I do these things? You need to make that stuff. And then this is the big one, consulting or professional fees tied to getting the business started. This is the key part when it comes to taxes. The IRS allows you to deduct up to $5,000 in startup costs and up to $5,000 of organizational costs. And the subject is to reduce your total taxes that cannot exceed over $50,000. And the rest can be amortized over the time, meaning that you can deduct the $10,000 in your first year. And then if you have more than that, you can amortize it or take it over the next few years.
Interesting. Well, that's good to know. That's good to know. And I didn't realize that it's more expensive to start an LLC in certain states than other states. You were saying it's might be a little bit more expensive in California than in Arizona?
Yeah. You have to pay higher fees.
Damn. But you can write that off though, correct?
You can. And that's important because I think a lot of people, when they see that, they're like, hey, I'm making some money for my business. I'm doing this stuff. And now I want to like form a legal entity and really make this into a legitimate thing rather than running it through my sole proprietorship. Not to say that running it on under your own taxes doesn't make it legitimate, because it certainly can still be legitimate under your own taxes. But some people will see those fees of $1,000 or whatever it is to start all of these things and say, well, that means I have to take it out of my own personal checking account that I've been saving money for to do that. Well, you can actually take it from the business and deduct it from the business. And therefore, at the end of the year, and this is something important, so let's understand it. Say you only made $1,000 over the year. Not a great business. You're still working at it. I understand that. But then your organizational cost to set up your LLC in California was $1,000. So in truth, when you report to Uncle Sam how much money you made, you get to say, I made no money, because I took the $1,000 that I made and it was eaten up by the $1,000 that was required to start the business. That is what a tax write-off is. You get to minus out how much you made, given that what you're doing is ordinary and necessary for the business to operate.
Interesting, interesting. I think there's a lot of stuff in there that people don't realize when starting a business. I mean, you talked a little bit about the legal fee setup. For a lot of people I talk to, I think they think that it's free, or you need like a lawyer, or it costs $10,000 to start a business. But I know it's very foggy for a lot of people who don't know. So this is great information.
Of course. Well, I'm glad that you're learning something, and hopefully I hope so are all of our listeners.
Yeah.
The next thing I want to get into is vehicle expenses. And this is one of the most commonly misunderstood deduction areas. And it's probably one of the biggest ones for getting yourself into trouble. This is the most important part. If your vehicle is used for both business and personal purposes, you are only allowed to deduct the business use portion for your taxes. And what that means is where most people get themselves into trouble is, hey, I know, don't worry. I just went and bought this Honda Fit for my business and I'm going to take my kids to school with it. And, I'm the business. Therefore, anything that I do with the business allows me to buy this vehicle. But in truth, in your heart, like when you're doing business stuff or when you're not doing business stuff, and you can sit there and try to say, well, I mean, I had to do these things. I had to drive my kid in order so I could be in good mental health so that I could run my business. But, or again, this is the most important thing. You are guilty until proven innocent if you were to get audited. So, how do you think that argument is going to land?
Not good. Not good. Nope. Not good at all. Yeah, this is the one that I see most often. Um, every time I see like a truck fly by and they've got a decal on it, I'm just like, I'm sure he's taking that home. Like that's not that's not necessarily a great like work truck. Like when you see like a construction vehicle, you're like, all right, that one's beat up a little bit. It's got tools, right? And then you see like a brand new lifted like
Mhm.
F Ford 250 just flying out. I'm like, I don't know. It seems excessive. It seems excessive. But I always wonder, it's like, man, if there is one to kind of stretch, this is the one that I feel like people stretch the most.
Yeah. And there's two main methods to deducting your vehicle's expenses. One's the standard mileage rate, and the other one's the actual expense method. And just so you know, for 2026, the IRS business mileage rate has increased to $72 or 72.5 cents per mile. But this is the biggest thing that people don't understand when it comes to doing this and making sure that it's business use. You need to have business mileage logs. Like that matters. Documentation matters more than your intentions. You can't just say, oh, I think I drove about this if you get audited. Because remember, you can get audited up to 5 years after the fact. So you're not going to remember what you did in 2020 or what you did in 2021 or 2026 as to how many miles. You need to have documentation on all of this stuff. And that's why it's so important to have a bookkeeper, to have something like um, QuickBooks. You need to be able to have these types of things that have these logs because you can't just say, oh, I think it was this or that. Again, you are guilty until proven innocent. So you need to have these logs so that you can say, this is how much I drove and this is why it was necessary for my business.
And you mentioned QuickBooks there. I know that's the one that I use that I really like. I've used it for quite a long time. But is there one that you would kind of recommend or the one that you would kind of steer away from?
No, not ones that I'd recommend or steer away from. I use an app called SimplyWise. It's very simple because I can just take screenshots of things,
Yeah.
or just take photos of it, and it automatically uploads from my phone, and it only costs like $30 a year. Where
Oh,
QuickBooks is a little bit more expensive than that. But whatever one that you can do, I've seen people just use Google Documents, and they just like are really avid at tracking. So whatever way that you want to, you just need to make sure that you're doing it. And I don't recommend just putting it all inside of a shoebox or putting it all into some random folder and saying, here it is. Digitized. Like we live in the 21st century, so let's use the 21st century technologies that we have.
100%.
The next one I want to talk about is the home office deduction. And this is probably one of the most talked about deductions if you go online. Like I get to write off these offices and therefore I get to live in my house for free because I'm writing this off. When you want to do a home office deduction, that means that the office that you're using or the space is regular use for the business. That means that you cannot. So for me in this office, I only use this for my business. But if I decided to put like a baby, like I don't know, a pool table in here and a few other things to hang out, well, that could mess up my ability to deduct this office if I decide to also make this into an entertainment zone for my friends when they come over. The space is to serve as the principal place of business, or otherwise if it's going to meet IRS requirements. So it's very important that you understand that this space has to work like that. Like for me, and this is going to be a little like crazy, this office, I deduct the each square inch of the office that I'm in, but I don't deduct the closet because in the closet, there's a bunch of storage in there that is just like other random stuff. that is not used for business use. I don't go into the closet to do business use. So when that door is closed, I only deduct what is inside of this square room and I don't deduct what's inside the closet, even though it's part of the room. That is how tight I run it. Now, because the IRS is not as crazy as I am, but I want you to understand how this works. You can't just say, oh, I have a 2-story house and I only do business in my office, which is upstairs. Therefore, the entire upstairs is my office. Or I work at home. Therefore, my home is my office. You can't deduct the entire thing. It's only what is used for the business exclusively or almost exclusively. And there's 2 methods for going able to write off. There's a simplified method, which is $5 per square foot up to 300 square feet. You're able to write off per year, or the actual expense method based on allocating eligible home cost by business use percentage. And again, if you don't know what this means, that's why we have tax professionals. They're able to do these things for us. So some common expenses that may be partially deductible if you do have a home office is your mortgage interest, your rent, your utilities, your insurance, and certain repairs to the home or the apartment. But this is not about writing off your house. This is about calculating the business use portion correctly. Because too many people think if I work at home, I have the ability to just send my house to the write off people. And if I send my house to the write off people, well, then I don't have to pay my mortgage. I don't have to pay any of these things anymore because the business will. And that is not the way the world works. That will end you up in jail.
And when you say stuff like utilities and stuff like that, if you're working from home, obviously I would assume, right, you would need the internet. You could write off the internet, right, Chris?
Yeah.
Yeah. A
Again,
portion
a,
of it.
a portion of it. I would talk with your CPA and figure out, hey,
Yeah.
what portion am I allowed to and not allowed to? But
Mhm.
yes, in general, when it comes to like for mine, I'm able to write off the entire amount. And sometimes
Yeah.
that even works for like cell phone use because it's almost impossible to say like, oh, well, I did this versus that when it comes to things like that. But again,
Mm,
that's for me and my CPA to decide what we're going to do. I'm not here to speak for what you and your CPA or your tax professional are going to come to, the right decisions on what's going to work for you or not.
of course.
The next one I want to talk about, speaking about, using your home as an office, is office rent or business space costs. For many business owners, they don't work at their home. They're going to be renting offices, a storefront, a studio, a co-working space. And the rent is generally deductible if it's ordinary and necessary for the business. So that's the reason that I really like those co-working spaces. We're able to go there because you don't have to do any of these weird tax loopholes. It's whatever you have to pay in order to have that working space, in order to have that storefront, that's automatically deductible. And there's other things that are deductible in relation to that, like your utilities, your maintenance, common area fees, internet tied to that workspace. It keeps it really clean and concise for taxes rather than working from home. So working from home is amazing, but it does complicate things a little bit when it comes to taxes. Where if you were to get an office somewhere else, which might be a bit more expensive, yes, it simplifies how you're going to be able to deduct as long as you keep accurate records.
And I think that's the key, right, Chris? Is to keep accurate records so that you can prove yourself to be innocent. You're not trying to screw over the IRS or the law or whatever like that. Because I actually didn't know that you're found guilty first. You're guilty, but you have to prove your innocence in the eyes of the IRS. I just think that's so interesting.
Yeah, and maybe that's the way that I put it, just to make it sound kind of extreme. Like you're not guilty
Yeah,
until proven innocent. But if they say like, "Hey, tell me what's going on here," like for better or worse, like you pretty much have to convince them, like you are guilty until you tell them like why you're not. And when it comes to somebody you don't want to get in trouble with, it's people that can garnish your wages, people that could really make your life hard. It's the IRS. So let's not mess with them. I mean, look at Wesley Snipes. How many years did he go to jail for tax evasion? Like it's not a penniless crime, or it's not a crime that you're just going to walk off into the sunset, pay a few dollars, do a dance here or there. Maybe if it's a little bit of money, go for it. But if you want to do this year after year after year knowingly, it could hurt.
yeah.
The next one that I want to talk about, and this one is probably one of the most clearest deduction categories and easiest to use, it's marketing and advertising. For pretty much all businesses, it doesn't matter how great your business is, if people don't know that you exist, well, then it's going to be pretty difficult for them to buy from you. So things that you're able to deduct are paid ads, website hosting, branding or logo design, content creation, email media messaging, any printed materials, or sponsorships that help you genuinely get promoted. But that does not mean that you can say, oh, I had to buy these concert tickets so I could go to this concert and like yell my business's name. Like you need to make sure that you are doing the right thing when you're going to advertising. So this one's usually pretty clear and concise, but I've seen people try to say some like weird stuff, like, oh, I had to pay to get my entire car wrapped. And then I have this, I had to, I bought this car and then I put this sticker on my car and the sticker has my business's name. Therefore, the car should be a tax write off. Like that is not marketing. So you need to understand these things. Because again, you are guilty until you're proven innocent.
And you find that a lot of people are doing a lot of wacky things in regards to the taxes?
I don't think that a lot of people are doing wacky things in their taxes until they go on TikTok, until they go on Instagram, until they see, oh, I can do these things. And then they try doing it. I feel like most people, they don't try these things until they see it, until they see someone saying, this is how I do it, which in truth, no, they're not. And then they end up getting themselves into trouble.
Yeah.
Spending when it comes to marketing should be related to promoting and growing your business. That's it. It's not about being extravagant. It's not or unrelated. You can't have these things just be crazy. I mean, I've had people say like, "Oh, well, I want to do marketing, so I want to rent a yacht and have a party so people can come onto my yacht and see like how successful I am as a business owner. We can just party together." That is not marketing. That is not advertising. You are not going to win that argument.
And I'm concerned by how often, this happens, right? Because when you were talking, I was just thinking, I was like, well, what if you threw a party at your office for maybe new clients? Could that be considered a
It's
write-off?
good.
That's good. That's good, right? Party for just the people in the office. Probably not a write-off because it's not part of
That
marketing.
that would be a write off. It just wouldn't go under marketing.
Gotcha. Okay. Okay.
Yeah, that would count. But like, hey, I just want to throw a party, or like, hey, my kid's having his first birthday party. I'm just gonna have a bonanza and invite everybody. And while I'm there, I'm gonna have in the corner a little, a little placard that says my business's name with a QR code. Therefore, I'm
Okay.
gonna write off the entire party as a business expense. That is not how that works.
Interesting. Interesting. Okay. Okay. It's starting to make sense. Starting to make a little bit more sense, hopefully for the people at home. Hopefully me as well.
So this is let's move on to section 7, business
Okay.
meals and entertainment. This one's important because people think like, oh, I just write off any meal that I have now as a business expense because I have to eat and I am the business. Therefore, anything that I eat is now free. Or entertainment. Anytime I go to the movies, anytime I do anything, again, it's my health. I need to be able to write off all of it. This section is really important because a lot of people confuse meals with entertainment. The IRS generally allows 50% deductions for qualifying business meals. If, and these are big ifs, the expenses are ordinary and necessary. I know we use those words a lot. The meal is not lavish or extravagant, and the taxpayer or an employee is present. So that doesn't mean that you can just say, "Oh, I'm just going to go ahead and I'm going to buy my wife DoorDash because she's hungry." Just because I'm in the room, like you have to be there, has to be for ordinary, and it can't be lavish. So you can't end up saying, "I want to go to Ruth's Chris with my wife for dinner tonight." This is going to be a business expense. That's not the way it works in any way, shape, or form.
It seems very gray, because like someone who pinches penny, anything going out would be lavish. Someone who goes out all the time, Chili's might not be lavish, right? But Ruth Chris might be a little bit more. So is it when it comes down, and I don't know if you'll know the answer, right? Because like we talked about, you're not a CPA, but who determines if it's lavish or not? Is that in the person paying the taxes, or is that like the person auditing, or is that just is it one of the gray areas of the tax code?
It is a huge gray area. Pretty much all of the tax code is gray area, and you're not going to like the answer, but the way that it's determined is how well you're able to convince, if you're getting audited, why it was ordinary and necessary. So it's up to you. It's up to your CPA, if you have one, or your tax attorney, to get you out of these issues by being able to have a convincing story. Sometimes people can just go in there with straight charisma and get out of doing some pretty awful things when it comes to taxes. And there's other people who just get effed over.
See that?
So
I can see.
something that's important for businesses and entertainment is that entertainment expenses are generally not deductible. And I think a lot of people don't understand that. So if you go out on go to dinner with a business partner, you can write off 50% of that. But the concert that you guys decide to go to afterwards to sweeten the deal is generally not deductible.
Okay, okay. What about travel expenses? Are we going to get into that one?
Yeah, we can get into that right now.
Let's do it.
So business travel can still be deductible when it's ordinary, necessary, and away from the taxpayer's tax home. So that means that you can't say, like, say, yeah, you live in Arizona. You can't say, like, hey, I'm going to go get this hotel in Phoenix where I already live because I really need to do it for my business. Like, why would you need to? It cannot be there. But if you need to travel for something for your business, you need to get a hotel and it's outside of where you live, then you have that ability to write it off. But the trip generally must be long enough that sleep or rest is needed. So you can't just go ahead and say, I want to buy a hotel as I'm traveling through things for no reason. Common deductions for this area typically include your airfare, your lodging, any ground transportation, baggage fees, and then part of it is your qualifying meals. But that also is going to work inside of your meals expenses. But if you're traveling, you do get a little bit of a break in that regard. Usually it's 100% rather than 50% because you will be by yourself. You don't need to have a person with you if you're traveling. And again, gets messy here. This is why we need to have professionals to help us out.
I could see why a professional in this regard would definitely help. This is serious stuff. And like you said, nobody really knows the whole tax code because I'm sure it's unbelievably long, right, Chris?
Yeah, it's so thick. I've only seen it once, and I was like, yeah, I'm not gonna read that.
I'm not reading that. But if someone did read it, I'm sure there's a bunch of goofy stuff in there that you could find as loopholes. But again, I'm just some guy. Don't listen to me. Don't listen to me. I didn't give you this information. Work with the CPA, do things correctly, be a good person. And I think we talked about this before. I think last time actually we did a podcast on taxes, but let's rather than trying to like figure out how to game the system and screw over the tax man, let's just go out and rather than take that time that you were planning on doing that, take that time to go make more money and work on your business and in your business, right? Rather than to actually try and get away from this because nobody gets away from taxes. It's can't beat the casino.
Yeah.
Can't
There's
beat them.
two important precautions that I want people to understand when it comes to travel. Number one is when you start mixing your professional with your personal travel, it gets messy extremely fast. So the more personal the trip, the more important the documentation becomes. I have heard too many people who say, "Oh, I'm just going to travel over here. I'm going to travel to this conference that I have to go to." So yeah, you get the airfare to go to the conference, you get the hotel for the night of the conference, but I'm going to stay for an extra week or so, and while I'm there, I might as well eat and do all these things. You can write off the airfare there. You can write off the airfare back. You can write off the hotel for the night, but you cannot write off the rest of the week. That's just not how it works. And again, you can't even use what I just said there. You need to talk to your CPA, to your tax professional to make sure that that's going to be okay. And you guys need to come to an agreement as to what's going to be best for you if you were to get audited. Because again, you are guilty until you are proven innocent.
And you have to act like that too. So that's why it's so important to keep great records. And I know a lot of people don't in regard to their taxes. So it's time. This is your wake up call, guys. to really I mean, we live in a world with AI and apps and phones and cameras. It's never been easier. It's never been easier to track these things. On the same hand, it's never been easier for them to track you on these things. So make sure that you are getting your ducks in a row and everything is the T's are crossed, the I's are dotted.
Yeah. Let's move on to section 9, and this is going to be our insurance, legal fees, accounting, and professional services. And this one is not very flashy, but it's super common and it's extremely legitimate. So possible deductions mean your business insurance, your legal fees related to your business, your bookkeeping, your tax preparation related to your business, consultants, contractors, freelancers, anything like that is 100% deductible. So that means, hey, man, it costs me, I think, $1,300 a year to file my taxes for my business. That sucks. Like, I don't like having to pay my CPA to do all that stuff. At least I know, though, that, hey, at least I get to take that out of next year's deductions. And you get to say, hey, I made $1,300 less on how much money I'm going to make because I had to pay for taxes, because it was required by the IRS in order to stay in compliance with the IRS. And it comes like with many things. Say you have a W or a 1099 contractor that maybe works in a foreign country, and you send them Zelle, or you Venmo them money whenever they do work for you. Maybe you got them on Upwork or something like that. That is 100% deductible, given that you have the record keeping that, hey, these are the services these people provided for me. This is the money that I paid them. And it goes like that for insurance, for legal fees, for consultants, for all of these things. As long as you know that this is the reason that I did these things.
I think that's very interesting that you have to pay to I always thought that was funny. You have to pay to like do your insurance. I'm sorry, to do your taxes. Um, but also I think it's important to know that um lost my train of thought real quick. I'll get it back. When we go on to the next one, I'm sure I'll think of it, but let's just continue on.
Yeah. I think the next one that's really important to understand is that there's phone, internet, software, and subscriptions. Like, this is where majority of my business ends up costing me a lot of money, that in marketing. But many modern businesses spend extremely heavy here without even thinking about it, because it's just part of doing business. And that might mean your business phone line, your business's usage a portion of the internet, CRM softwares, scheduling tools, project management tools, accounting softwares, video conferencing software subscriptions, AI productivity tools like ChatGPT or the higher Claude version or whatever you like to use. Usually, when people think about these SaaS companies, software as a service, they're small, at $30 here, $10 there, once a month subscriptions. I have to just pay. Like, for us, we use Riverside FM. That costs me not too much money every month, but that is something that I'm allowed to deduct. So these small reoccurring costs are really easy for people to ignore, but they often become meaningful over time. To say, oh, I only have to spend, I don't know, $15 a month on this subscription that doesn't cost, ChatGPT only costs $20 a month. That's not a big deal. But over the year, that's nearly $250, $240 that I can write off of my taxes. Like, what are you willing to do right now to save $240 on your taxes? Because in truth, it's not going to save you $240, but it will help you quite a bit. And if you don't understand the difference between a tax deduction and a expense, or not deduction, um, between a tax write-off, a tax deduction, um, then you need to go and listen back to some of our past tax podcasts where we talk about that. Because just because you saved $100 on your taxes, that does not mean you get $100 in your pocket.
Yeah, and I can see where this one would be one of the more important ones for, just not necessarily like big corporations, but like for like mom and pop operations, right? Single guy operations or, small businesses like this. I mean, these softwares, like you said, they do add up and they're common. I mean, every business needs phone, internet, all these different things to make the business run. But we kind of forget about it. You forget sometimes that's like, oh, yeah, it is a possible write off. And that's important, and I forgot that, honestly, like, "Oh, yeah, ChatGPT," stuff like that, but again, how are you using it for your business, right? It's like, well, ChatGPT is also my therapist, my
Mhm.
my soccer coach, my recipe coach, it's like, Okay, how much of that $20 is, for the business? So I guess again, it's another very gray area. Do you have
Hmm.
separate accounts for your business? And that's really what you should have, right, Chris? You should have everything separate, business and you, if you are just one man.
Ideally,
Yeah,
it's extremely difficult, man. Like it's
yeah,
extremely because that means now I have to buy for two different
for two.
subscriptions, and now I'm
Yeah,
paying double the thing. So the IRS understands that, like, no one's gonna be perfect, but your goal is to try not to cheat. Thank you so much for joining us for part one of the top business tax write offs for 2026. Be sure to join us for part two this coming Friday for more exciting ways to save yourself money. We'll see you there. This video podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the host and guests, not the podcast sponsor.
it is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.